Have you ever just stared at a chart, completely lost in a sea of lines and signals? Well, if that's you, you're in the right place. Today, we're going to build a systematic framework, a real step-by-step guide to test any trading indicator out there. We're turning all that guesswork into a powerful, repeatable process that can give you a genuine edge. So, here's our game plan. First, we're going to tame what I call indicator chaos. Then, we'll get into building your actual trading rules, engineering your risk, and then, the really fun part, testing it all with historical data. And finally, we'll talk about how to keep observing and refining your system, because the work is never really done. Let's dive in. All right, our very first step is probably the most important one. We have to tame the chaos. Before we even dream of building a system, we've got to fix the number one mistake traders make, and that means choosing one single, reliable tool to be our foundation. Think about it. So many traders get trapped by these whipsaws where the market just zigs and zags and all these other full signals. And why? Well, it's usually because they're piling on indicator after indicator, hoping for some kind of magic formula. But here's the secret. The goal isn't more data, it's more clarity. And we're going to get that clarity by focusing on just one tool to start. For our example today, we're going to use a classic, the simple moving average. And why the MA? Because its main job is just to cut through all that daily price noise and show you the underlying trend. It answers the most fundamental question you can ask. Is the price generally going up, down, or just sideways? That's our starting point, our baseline. And even within this one indicator, there's a really important trade-off you need to understand. You've got this simple moving average, the SMA, which is kind of like the tortoise. It's stable, it's steady, and it's great for spotting those big long-term trends. Then you have the exponential moving average, the EMA, which is the hare. It's faster, it's more responsive to what's happening right now, and a lot of short-term traders love it. The choice you make right here pretty much defines your entire trading style. Okay, so now that we've picked our tool, we can get out of the world of theory and into actual practice. It is time to build a non-negotiable set of rules. A real blueprint for exactly when you get into a trade, and just as important, when you get out. This is the part where we eliminate all that guesswork. The legendary trader Marty Schwartz had this exact red light, green light system. It's brilliant in its simplicity. This is the whole idea in action. A really good indicator isn't some complicated mess. It creates simple, objective rules that take emotion and hesitation completely out of the equation. The real power here is creating rules that are precise and mechanical. For our system, it's a simple three-step process. First, you identify the overall trend. Is the price above or below our moving average? Easy. Second, you define your entry signal. A classic example is the golden cross, right? That's when a faster average crosses above a slower one, signaling new upward momentum. And third, you define your exit with the death cross, the exact opposite. These signals are totally objective. They either happen or they don't. No room for interpretation. So, we've built our offense. Now it's time to build our defense. And let me tell you, this might be the most critical step of all. Engineering your risk. This has nothing to do with limiting your profits. It has everything to do with ensuring your survival, so you can actually stay in the game long enough to be profitable. The stop loss. This is your single most important risk management tool. Period. It's your predefined escape hatch if a trade goes sour. Think of it like a circuit breaker that protects your capital from a catastrophic loss. It's non-negotiable. But listen, not all stops are created equal. A static stop, let's say just putting it 20 points away every single time, it's just fundamentally flawed. It totally ignores the market's personality. A dynamic stop, on the other hand, it adapts. It uses a measure of current volatility. So in quiet markets, the stop is tighter, but in wild, volatile markets, it gives you more breathing room, which keeps you from getting shaken out by normal price swings. In setting a dynamic stop like this is actually a really simple four-step process. First, you just find the current average true range or ATR value on your chart. Then, you pick a multiplier. Something like 1.5 or 2 is common. Then, you just do the math to calculate the distance and place your stop. This simple little process ensures your risk is based on what the market is actually doing, not just some random guess. Okay, so let's recap. We've got our entry rules, we have our exit rules, and we have our risk management defined. We have a complete system on paper. But does it actually work? Well, it's time to find out. It's time to go into the lab and validate our strategy like a scientist, using the power of historical data. And that's where backtesting comes in. This is your personal trading laboratory. It's where you can run your strategy through months or even years of past market data to see exactly how it would have performed, all without risking a single penny of real money. This is how you build true data-driven confidence in a system. So you run a backtest, and hey, maybe it was profitable. But is that the whole story? Not even close. We need to measure its performance objectively to understand its real character. Was it a smooth ride, or was it a total roller coaster? And does it even fit your personal tolerance for risk? These right here, these are the numbers that really matter. Look, a high win rate feels awesome, but it's totally useless if your few losses wipe out all of your gains. That's why we have to look deeper. Profit factor tells you how many dollars you make for every single dollar you risk. Max drawdown, that reveals the toughest losing streak you would have had to live through. But the holy grail, the ultimate number, is expectancy. If that number is positive, it means your system has a mathematical edge over time. If it's 0 or negative, it's a losing game no matter how good it might feel in the moment. Let's be real, no strategy is perfect, and markets are definitely not static. So the final step, and honestly maybe the most important one, is creating a continuous loop of improvement. This is where you observe what's happening, you journal your trades, and you refine your system based on what the market is actually telling you. Through all this testing and observation, you are absolutely going to discover the main weakness of any moving average system. It just struggles in those sideways, choppy markets where there's no clear trend. It gets whipsawed back and forth. So the big question becomes, how do we filter out all of these false signals? Well, the solution is to build a validation matrix. Instead of just blindly following a single signal, you look for confluence from other, different kinds of tools. It's like building a checklist. Before you take a trade, you run it through the list. For momentum, you might use an oscillator like the RSI to see if there's real strength behind the move. For trend, maybe you use the MACD to confirm the direction. You check for a big spike in volume to validate the breakout, and you zoom out to a higher time frame to make sure you're not swimming against a bigger current. When multiple, non-correlated indicators all line up and agree, your odds of success go up dramatically. You know, when you really boil it all down, this whole thing comes down to a shift in perspective. Successful trading isn't about finding some magical, perfect indicator. It's about building a robust, disciplined, and repeatable process for analyzing the market, executing your trades, and managing your risk. This framework is designed to transform you from just being a passive indicator user into an active strategy architect. You literally have the blueprint now to stop chasing random signals and start building real systems. The market is just this endless sea of data. The real question is, can you build a process strong enough to navigate it?